Building an exceptional credit score is within reach, even if your budget is tight. A perfect credit score can open doors for the best financial opportunities, including lower interest rates and higher credit limits. The good news is, you don't need to pay for expensive services to boost your score. With the right strategies and a bit of discipline, you can build and maintain a perfect credit score for free. In this video, I'm going to try to help you increase your credit score with 8 methods that could send you on your way to a great credit score of 800 plus. With that being said, let's dive right in. Number 1, using your credit card. Credit scores show how good you are at borrowing money. Lenders use these scores to decide if they should give you a loan or a credit card. The higher your score, the better. Most lenders like it if your score is 700 or above. When you have a good credit score, you can borrow money with lower interest rates. You can also get credit cards with better benefits, like higher spending limits and cool rewards. To have a credit score, you need a credit history. The first step to building a credit history is usually getting a credit card. Not using a credit card can be a problem. If you don't have any credit history, you're invisible to lenders. They can't decide if you're good or bad at borrowing money. And if you have a credit card but haven't used it in a while, the bank might close it. If this card is the oldest one you have, it could lower your credit score because your credit history won't be as long. Your credit history is important because it makes up 15% of your total credit score. So you need 1% or 2% monthly utilization of your credit card. You can make a small purchase with them now and then each month. This helps keep the cards active. Also, it's important to set up automatic payments for these cards so that every month the full amount shown on your credit card statement gets paid off automatically. Don't leave any balance unpaid, as this can lead to extra charges. Number 2, make on-time payments. When you start building your credit history and you're aiming to establish a good credit score, there's one rule that stands out above all others: pay your bills on time. This is very important because it's the main thing that affects your credit score. Think of your credit card as a short-term loan that you get from the bank. Every month you buy things using your card, and at the end of the month you have to pay the bank back. If you don't pay the full amount, the bank charges you extra money called interest. This interest can add up fast, and credit card interest rates are usually very high, often around 15% or 20% or even 25%. That's a crazy amount to pay just because you didn't pay your bill on time. Unlike other loans, like car loans or mortgages for buying a house, you don't need to pay interest on credit cards. So it's really important to always pay your credit card bill on time to avoid those high interest charges. Additionally, missing payments can lead to serious consequences. If you're consistently late with your payments on credit cards or loans, say 90 to 180 days late, your account could be handed over to a collection agency. This not only means more financial trouble, but also negatively impacts your credit score. And this damage can linger on your credit report for a long time, up to 7 years. On the bright side, making payments on time is not just a smart financial move, it's also a good personal habit. It shows responsibility and reliability, which can go a long way in maintaining a healthy financial life. Number 3, don't use too much credit. Your credit score isn't just about paying bills on time. Another important factor is your credit utilization, which is the amount of revolving credit you're using out of the total credit available to you. If your credit card limit is $1,000, try not to spend more than 30% on it, which is $300. Here's where it gets tricky. Some people max out their credit cards thinking they'll pay off the balance in full by the due date. Let's say you spend the entire $1,000. Even if you pay it all back on time, your credit score could still take a hit. Because during the time between when you made the purchase and when you paid it off, your credit utilization was 100%. When it comes to credit cards, financial institutions such as banks have a preference for borrowers who keep their credit utilization below 30%. When you use a big portion of your available credit, it suggests to lenders that you might be financially stretched. If an unexpected expense were to arise, such as a medical emergency or a sudden job loss, you might struggle to make payments on your debts. This increases the risk for lenders because there's a higher chance that you might default on your loans or miss payments. On the other hand, if you keep your credit utilization low, it demonstrates responsible financial management. It shows that you're not overly reliant on credit to cover your expenses, and you have a buffer in case of emergencies. As a result, lenders are more likely to view you as a low-risk borrower and may be more inclined to offer you favorable terms, such as lower interest rates or higher credit limits. If you're enjoying this video, hit that like button, subscribe, and turn on notifications for more valuable content. Number 4. Don't spend money you don't have. Many individuals fall into the trap of overspending, which occurs when they use funds they don't have. It's important to always stick to the principle of spending only what you currently have available. For instance, if your credit card allows you to spend up to $1,000, you should ensure you have that full $1,000 in your bank account to cover any purchases you make with it. Similarly, if your credit card limit is $30,000, you should only spend that much if you truly have $30,000 available to pay off the balance. Always view your credit card as a tool that allows you to borrow money up to a certain limit. However, it's important to understand that the money you borrow must eventually be repaid. Therefore, before swiping your card for a purchase, you should verify that you have enough money in your bank account to cover the amount you plan to spend. This approach ensures that you won't have financial difficulties or accrue unnecessary debt by spending beyond your means. Number 5. Never make the minimum payment. Making only the minimum payment on a credit card is a common mistake, and it's easy to understand why so many people fall into this trap. When you first get a new credit card, it feels great. You use it for various purchases, enjoying the convenience and rewards it might offer. However, when the bill arrives, it includes a few options. You can either pay the full amount you owe, which is the statement balance, or just a small portion of it known as the minimum payment. This minimum payment might be something like $20, $30, or $35. Choosing to pay only the minimum amount can seem tempting, especially if your overall bill is quite large. It feels manageable, and you might think you're keeping up with your payments by doing so. Credit card companies often make it seem like making the minimum payment is a good enough way to handle your debt. They might even make it the easiest option to see and choose on your bill. But making only the minimum payment each month is not good for your finances in the long run. When you don't pay off your full statement balance, the remaining amount starts to accumulate high interest, often around 15 to 25%. Then the amount you owe grows quickly because you're being charged a lot for borrowing that money. Even though you're making payments, the balance you owe doesn't decrease much. Most of your minimum payment goes towards paying the interest, not the actual amount you borrowed. This keeps you in debt for a much longer time. Regularly carrying a high balance on your credit card can hurt your credit score, making it more difficult or expensive to get loans or other credit in future. So always make the full payment. Number 6. Avoid cash advance. Avoiding cash advances from your credit card is crucial because the interest rates on these transactions are extremely high, often much higher than the rates for regular purchases. When you withdraw cash using your credit card, the interest rate applied is typically much higher than the rate for regular purchases. This means you'll end up paying more in interest charges, which can quickly accumulate and become overwhelming. Unlike purchases where you may have a grace period before interest starts accruing, cash advances begin accruing interest immediately. There's no grace period, so from the moment you take out the cash, you're already being charged interest. On top of the high interest rates, credit card companies often charge a cash advance fee. This fee is usually a percentage of the amount you withdrew, often around 3 to 5%. This means if you withdraw $500, you could be charged an additional $15 to $25 just for the transaction. Frequent cash advances can be a red flag to lenders, as it may indicate financial instability. This can negatively impact your credit score, making it harder to get loans or other credit in the future. Given these drawbacks, cash advances should only be used in the most dire emergencies, when you have absolutely no other options. Number 7. Using the wrong type of credit card. Don't just get any credit cards without a clear reason because they were offered to you, or simply because other people around you are getting them. Instead, be intentional with your choice of credit card. When choosing a credit card, consider how it can best serve your specific financial needs and goals. For instance, if you pay rent, look for a card that lets you earn points on rent payments while covering the transaction fee. This way you can benefit from your regular expenses without incurring extra costs. Alternatively, think of your spending habits. If you spend a big amount of money on gas and groceries, look for a card that offers substantial rewards in those categories. For example, the Citi Custom Cash Card provides 5% cashback on your highest spending category each month, such as gas or groceries, without charging an annual fee. This kind of targeted reward can maximize your benefits based on your actual expenses, helping you save money or earn more rewards over time. Number 8. Go easy on the number of cards. When it comes to managing your credit, it's important to be careful about how many credit cards you have. While it might be tempting to apply for multiple cards at once, especially if you're eager to build your credit quickly, this strategy can backfire. Start with just one credit card. Having one card allows you to focus on managing it responsibly. You can get used to making purchases, paying off your balance on time, and understanding how interest and fees work. Once you've successfully managed your first credit card for a while, usually at least 6 months, you can consider applying for another one. This gradual approach gives you time to establish a good payment history, which is a key factor in building a strong credit score. Some banks and lenders like to see that you have more than one type of credit because it shows you can handle different kinds of credit responsibly. However, if you apply for multiple credit cards at the same time, it can make you look financially desperate. This suggests that you might be in urgent need of credit, which is a red flag for lenders. They might worry that you're having trouble managing your finances or that you might be planning to accumulate a lot of debt quickly. As a result, applying for too many cards at once can hurt your credit score. With these tips, you can work towards a perfect credit score without spending a dime. It's all about being responsible with your credit and making smart financial decisions. With patience and diligence, you'll see your credit score improve, opening up more financial opportunities for you in the future. Have you tried any of these tips, or do you have any other strategies that have worked for you? Let us know in the comments section below. If you found this video helpful, please like and subscribe for more valuable content and financial insights. Thanks for watching.